Our next topic is selling short. Selling short is a trading operation connected to the sale of shares. This operation often causes bewilderment for the starting investors because it is possible not only to buy and sell shares that one owns, but also to sell shares that an investor does not own. In the case of a short sale, the investor places an order to sell short, at which time the broker, in effect, loans the specified number of shares at their current value to the investor for this transaction. Subsequently, the investor must repay this loan to the broker, purchasing an equal number of shares on the open market. Now, what's the benefit of using a short sale? Well, if the investor believes that the shares of a company will fall in price, it would make sense to sell the shares while the price is high and then buy it when the price drops, thereby taking a profit. Now, how does the investor make a profit on this transaction? Let's take a look at an example. Let's say the shares of XYZ cost $80. And the investor expects the price to fall. The investor places an order to sell short 100 shares. Now, once the stock is sold, the investor receives $8,000 in their account. Now let's say the price of XYZ stock then drops to $70 per share. At this time, the investor purchases 100 shares of XYZ stock for $7,000, covering the debt owed to their broker and thereby closing a short position. The investor made $8,000 on the short sale, spent $7,000 to close the short position, and keeps the difference of $1,000. In this section, we're going to review fixed income securities. Fixed income securities promise to pay to an investor a defined amount over a specified period of time. Now, depending on the form of payment, fixed income securities are divided into two groups. Pure discount securities, where the payment occurs only once, as a rule, upon maturity. And coupon payment securities, where the investor receives a series of payments, usually of equal amounts, called coupon payments. In both cases, there occurs a day after which payments cease. This day is called the maturity date. At the date of maturity, the investor receives the initial amount of the investment. the principal or face value. Now, the following are different types of fixed income securities. The first we're going to look at are commercial papers. Commercial papers are the short-term, unsecured debt of large corporations. Usually, commercial papers are sold in denominations of $100,000 or more and have a maturity of up to 270 days. The next is certificates of deposit. These are securities issued by a commercial bank or thrifts. The next, banker's acceptance. This is a written promise from a buyer to a seller to pay a specified amount in a short period of time. A bank accepts this promise with the obligation that it will pay the amount to the seller, using the purchased goods as collateral. The seller, upon receiving the promise from the buyer, may wait for the payment or sell the banker's acceptance for an amount less than the promised payment. The next is Euro-dollar CDs or Euro CDs. These are large short-term certificates of deposit in U.S. dollars released by banks outside the U.S. The next is a repurchase agreement. This is where one financial establishment sells to another financial establishment a package of high-quality securities and agrees to repurchase the package for a higher price at a specified date. The difference in the prices is the interest rate and is referred to as the repo rate. The next are U.S. government securities. These are the debt instruments used by the U.S. government to cover expenses or to refinance public debt. The low level of the risk associated with U.S. government securities determines their low yield. There are three types of government securities. The first are Treasury bills. These are short-term securities with a maturity of 1 year. They are sold at a discount of their face value, which is $10,000. The bills with a maturity of 13 and 26 weeks are released each week. The bills with maturities of 52 weeks are released once per month. Now, the state can use the new issues for cancellation of the prior debts. Such practice is called debt refunding. The next are Treasury notes. These are the intermediate term debt of the U.S. government, which are issued for a period of 1 to 10 years. Interest is paid semi-annually. T-notes have a face value of $1,000. The next are Treasury bonds. These are the long-term debt having maturities of more than 10 years. The difference between the T-notes and T-bonds is that the bonds can be recalled by the government before their date of maturity. This is referred to as call provisions. The next we're going to look at are federal agency securities. These are the debt of various American federal agencies, such as the Export-Import Bank, the Postal Service, Federal Housing Administration, the Department of Defense, etc. Also, agencies financed from the federal budget. For example, federal home loan banks or the Federal National Mortgage Association. So, federal and local government securities are the debt issued by the various governmental bodies in order to finance different projects. The most common form of these securities is municipal bonds. Corporate bonds. These are the debt of large companies. The risk associated with the purchase of corporate bonds is greater than that of the government and federal agency securities. Therefore, the yield of the corporate bonds is higher. In order to correctly evaluate the degree of risk of an investment with various companies, it is necessary to take into account ratings of financial risk, which are evaluated by special agencies. The most well-known agencies are Standard & Poor's and Moody's. Now the rating scales look like this. AAA for both Standard & Poor's and Moody's means best quality. AA for both means high quality. Single A for both means upper medium grade. Triple B for Standard & Poor's and BAA for Moody's means medium grade. Double B for Standard & Poor's and BA for Moody's means they have speculative elements. A single B for both means speculative. Triple C and double C for Standard & Poor's and CAA for Moody's means default possible. C for Standard & Poor's, and CA for Moody's means in default. Triple D to D for Standard & Poor's, and C for Moody's means extremely poor prospects. Now continuing on, foreign bonds. These are the debt securities released outside the country of the issuer. The next, Euro bonds. These are the debt obligations sold outside the country of the issuer and not in the currency of the issuer's country. A good example is the debt of the Russian companies. They are sold in US dollars and placed in the Western European markets. The next, preferred stock. These are shares of corporate stock whose holders have priority over those holding common stock to the incomes and property of a company. Therefore, those holding preferred stock receive payment of the dividends first. In the event of a company going bankrupt, the holders of the preferred stock also have the priority in obtaining a share of the property of the company. However, the holders of the preferred stock, as a rule, do not have voting rights on choices of management of the company, as do those holding common stock. In essence, the preferred stocks are permanent bonds, which bring to the holder a fixed income. This fixed income is similar to payments received via the bonds. However, it's called a dividend rather than an interest payment. Now, the holders of common stock receive dividends in an amount approved by the board of directors of the company. However, the preferred stock dividends are always fixed and are known from the very beginning prior to the purchase of these stocks. There are 4 types of preferred stock. The first, cumulative preferred. If a company has not paid the dividends on time, or in the complete amount to those holding the preferred stock, the unpaid amount must be paid in full before dividends can be paid to those holding shares of common stock. The next are adjustable rate preferred, or ARPs. In this case, the amount of the dividends is periodically revised and is anchored to any concrete interest rate. For example, to the interest rate of the 3-month Treasury bill, or to the rate of the 10-year Treasury bond. To make ARPs more attractive to the investors, the amount of the dividend often exceeds the amount of the interest rate by a little. The next are convertible preferred. At the will of the holder, such shares can be converted to shares of common stock of the company within specified conditions. And the last are callable preferred. This type of preferred stock can be withdrawn by the issuer. This usually occurs when the size of the dividends paid on preferred stock begins to considerably exceed the value of the main interest rates in the market. Now, the callable preferred stock favors the issuer rather than the investor. So there are two approaches used in order to keep investors' interest. Firstly, the stock is recalled at a price slightly higher than the face value of the preferred stock. And secondly, an offer of call protection can be made. According to this procedure, it is stipulated that the callable preferred stock cannot be withdrawn during the first 3 to 5 years following issue.